Hello and welcome back. My name is Josh, and today I want to discuss a company that's done terribly over the last year, uh, down 78% from its highs. And in case you can't guess, it's over here, but it's Peloton. Full disclosure, I am an owner in Peloton, and full disclosure, I am still optimistic about the future. And I'll give you a couple reasons why. So first, let's talk about Peloton. What do? They sell exercise equipment and a subscription. So they make money in two ways: selling devices and selling a subscription. A subscription similar to Netflix, but it's you can watch their workout classes. And I think this is the core reason why I'm a believer is because of this dynamic between subscription revenue and device revenue. So I'll get to that. So what do I mean? So let's look at some numbers. So Peloton, this is their overall revenue. And as you can see, they had a very successful growth. They doubled from 2019 to 2018, then doubled again, and then more than doubled in 2021. But next year, they're projecting only 10% growth. So they're projecting 4.4 to 4.8 billion. I took the low end. That's only 10% growth. That's a significant reduction from um, what's this growth rate? They grew 120% the year before. So to go from 120% growth to 10% growth is extremely disappointing, which is why we see here the company, in 2021, in 2020 they were projecting huge growth numbers. So in 2021, so they grew like crazy. Then you can see from here now they're projecting much slower growth, and the story behind Peloton, the growth story, has significantly slowed down, which is why the stock is down so much. So why is the stock down? I have a couple of reasons. One, growth is slowing. Two, they actually dropped, this isn't in order, but they dropped the price of the bikes. And that's typically a bad sign. You don't see really good companies like Tesla that have tons of demand dropping the price on cars, or Apple. In fact, typically a sign of strength is increasing price because there's so much demand out there that you don't need to lower the price, you can raise the price. So a price drop is a pretty negative sign. So a lot of people saw that as a very clear negative, that there's not a ton of demand. The other reason, which is talks back to this, um, actually I'll go to the fourth reason, then I'll go to this one, which is to me the most important, but they pulled forward sales. A lot of the companies during COVID pulled forward sales. Netflix even discussed this where, typically they grew about 10 or 20 million users a year, and then, they had 40 million one quarter, or something like that. And so they said growth's going to slow because, the people that were going to subscribe next quarter, the quarter after that, or the quarter after that, suddenly subscribe this one. So there's not as much people now to go after. So they pulled forward so much demand, um, that they expect that the growth's going to slow. So, but the biggest reason, and this is related to the price drop and the pull forward, is um, they lowered the gross profit on the devices. So what is gross profit? It's basically the revenue you make after looking at the input cost. So, you sell a device, a bike. What is the input cost? Well, there's machines, there's parts and labor. You got to bend the steel, you got to get the plastic. So after all the inputs, and how much you made from the device, what are you left with? So that's gross profit. So they were typically, these are rough numbers, but they were typically making about 35% gross profit on their devices. And that dropped significantly to only 15% on their devices this year. Part of that's because they lowered the price. So again, if your input costs are the same and you lower the price, your gross profit's less. Also, they had some supply chain issues, so that also squeezed the gross profit. And that's why we can see, even though their revenue on devices doubled, because the gross profit is more like went down by more than 50%, the actual gross profit they made on devices is actually down. Now, again, these aren't exact numbers, these are rough numbers, but roughly speaking, they actually, even though they sold twice as many devices, they actually didn't make as much money on them because of the price drop. So they sold more devices at lower margins. Um, and so a lot of people said this is really bad, margins are down, growth slowing. This is typically a horror story. So now I guess the question is, why am I optimistic? So the way I see this is this company is very similar to another company, two other companies that I think are in similar situations. One, Roku, which again, you can see another thing where it went up and then it's gone down, but Roku even before that was doing very well. And you can see it was up, 300% from, 2018 to 2019. And Roku does a similar thing. They sell hardware and they sell software. And so they sell a little stick that you stick in the back of your TV. And then they also make revenue from software. And if we actually look at here is from 2016 onwards. This is their revenue from selling physical devices, and this is their software device. So you can see that originally the ratio of hardware to software is about 75%. Actually, let's do this. This is probably a better way of looking at it. 42% of their revenue was from hardware, but as they grew, they didn't really sell a ton more devices. You can see it's gone up, but it's this is quarter by quarter, by the way, but it hasn't really changed too much. Years later, we're 5 years later, and they did that. I think Q4 is their best quarter, which is why you see some bumpiness in this. But they had 110 million in hardware in Q4 2016, and then in Q1 2021, they had basically the same amount. But software revenue has doubled. You can see the percentage of revenue from software has grown significantly. This is hardware revenue, so you take the inverse of this. So they went from about 58%, 57% from software to 78%, so a lot more. This is really good. Software revenue one is higher margin. So again, like the input cost of a bike, there's machines, there's parts, there's all this. What's the input for software? It's typically much lower. It's like servers. There's typically some. It depends what the exact thing is, but like for Peloton, what's the input cost to their subscription revenue? Servers, paying for instructors, paying for space, and then because there's people working on, they film that. So cameras, that's much lower than to build the actual thing because you charge $40 a month every month for that. And it's per user, so you get hundreds of thousands of people. And if you have one user, you pay the same for all the for the people riding the bikes than if you have 100 million. So typically your margin goes up as you grow, which is why people like SaaS companies and Netflix, they're very high margin and they're very sticky. People stick with them month after month. So as we can see here, I have the device revenue and the subscription revenue as well as the gross profit. So device revenue has been growing, but it's kind of plateauing now. And their gross profit's down. Meanwhile, the subscription revenue is also growing significantly, but it's going to continue to grow, and their gross profit's actually up. Now, these are projections. This is 2022 and 2023. These are projections, but based on their report here, you can see here Connected Fitness. I looked at the guidance, and they basically said full year ahead what they expect from full year. They said they expect 4.4 million. Where is this? 4.4. I can't find it. Do I have the right one? Oh, sorry. This is the letter I mean. I hate it when companies don't do the same quarters as we do. I.e., their first quarter 2022 was actually Q4 2021. All right, here's what they're expecting. They're expecting 4.4 to 4.8 billion. They expect total profit margin of 32. Anyway, I went into it, I broke it down, and they basically expect 15%-ish and 70% from gross profits for subscription. So you can see here the percentage of revenue that's from subscription. It's slowly grown for 18, 19, 20, 21, but it's going to quickly increase to about 33% by 2023, I expect. And when you actually look at the percentage of gross profit, it's even quicker moving because, again, this is much higher gross profit than this. So they used to make about 25% of their money from subscriptions, and by 2023, I'm expecting 70% of their gross profit to come from subscriptions. So again, what's happening? They're selling these devices. They've kind of plateaued. They're going to sell a bunch of devices, but it's not really going to grow. They're going to sell, let's say, 1 million devices. I'm making up, it's not 1 million devices. And they went from 250,000 to 500,000 to 1 million. Well, now they're only selling 1 million every year. But the point is, the total number of users who have it is now growing year after year after year. So now they have 1 million, then next year they're going to have 2 million, then they're going to have 3 million total people. So even though they're only selling 1 million devices a year, the total number of people subscribing is growing. And we can see that clearly here, where even though this is their total revenue. quarter over quarter, you can see here tons of growth, and then you can see, oh my goodness, look, revenue's actually down. But it's because total revenue's down because they're moving from, despite total revenue being down, you can see here the total number of subscribers is up still, quarter after quarter. So they're moving from low margin revenue, that's hardware devices, to high margin subscription revenue. And that was really the reason for the price drop. It was a strategic move. Some people don't like it, but I think it's a great move. And this is my two reasons for optimism. One is transition to higher margin subscription revenue. Again, people who pay are paying about $40 a month for the subscription. That's 4 times Netflix. They want to grow as many subscribers as possible. So they said, how do we get as many subscribers as possible? We drop the price. So they're just trying to get their device out there as quickly as possible. Again, for Roku, the device is like 20, maybe $50, maybe even, I don't know exactly, but it's a cheap device. Easy to sell it and get it out there, and that's how you grow your software revenue. For Peloton, this is an expensive device. It's $2,500. Before, I think in Canada it was even more. It was $3,000. It's a big purchase. So how do you make that? How do you grow your subscriber count? Well, you make it easier to buy. So they drop the price to try to get as many people into the ecosystem as possible. And once you have more people in the ecosystem, you can sell them shit. This is kind of similar to what Apple did. Apple was a hardware device. They made iPhones. People loved them. But you can see here their price to earnings and their price to sales ratio. So when they were a hardware device, their price to sales was about 3 for years. Why? Because the revenue from iPhones, yes, you make a lot, but you don't actually make that much percentage. Maybe you make 30%. And then they started selling more software stuff. iCloud, Apple Music, Apple Game, which I think is called Apple Arcade, Apple TV Plus, which is their prime competitor. Those are much higher margin and much stickier. And so you can see in the last couple of years, the price to sales has gone up significantly. Same with their price to earnings. Same thing. So they were paying about 10 to 15 times earnings, and now they're paying about 30 times earnings. Why? Because earnings from subscription revenue is much more valuable. It's recurring. You don't have to do as much marketing. Again, if you buy an iPhone, you sell someone a device, then 3 years later, you hope you can sell them another device. You don't really make any money in between, and you got to market to them again in a couple years. Hey, do you want a new device? Hey, here's why you should buy it. With subscription, you have them in the ecosystem. You get money from them month after month, and there's not a lot you have to do to get that money. So that's one reason that I think, again, this company it's going to be a bit of a grog for a bit, because they have to tell this story of transitioning from, hey, we're growing devices, to, hey, we're growing subscribers. We're trying to build the Netflix of fitness. And that's really what I think they're doing. The second thing is untapped commercial. So last year they bought a company, you can see here, Precor. So this company, Precor, is now called Peloton Fitness. What do? They sell to health clubs, corporate wellness, education, fire departments, law enforcement, medical and rehabilitation, multifamily housing, that's like condos and rental properties, and hospitality. So that's, hospitality is going to be hotels, cruise lines, stuff like that. This is a huge untapped market, I think. So currently Precor goes and says, hey, Hilton, Hyatt, Health Club, LA Fitness, there's lots of people using their devices, so they go through them, so they have relationships with them, and they sell them en masse. Now, when you sell directly to businesses, you typically are selling much higher volumes, but it's lower margin, because, if I'm buying 1,000 pieces of workout equipment, I don't want to pay the same price as Joe Schmo who's buying one. So typically you get a discount. But the whole logic here is, right now, Peloton's only been selling to individuals. And that's a big market, You look at the top 20% of users, in the US and Canada and Germany and Spain and in the UK and Australia, and you're selling to more affluent people, because, again, it's an expensive device and it's $40 a month. But it's expensive to sell to individuals. You got to market to them a lot. But I think there's a huge untapped market on the commercial side. I think I could see, the way I ask myself this is, and again, I try and break it down to a simple thing. Is the future going to be more connected devices? Do you think in gyms and health clubs and all these places, are devices more likely to be connected in the future, or what I'll call dumb devices? Smart devices, smart workout machines, or dumb workout machines like they are now? To me, it's a no-brainer. In the future, you're going to see more likely to have smart connected workout devices in health clubs and in hospitality. Okay, so that's question number one. So it's a growing market, we think. Two, is Peloton going to be one of the leaders? Right now they're the leader, but are they, maybe they're number two in the future, but are they going to be one of the leaders in this connected workout equipment market? I think so. Now you might say no, there's a lot of competition. There's new companies like Mirror, which I think was bought by Lululemon. There's Zwift. There's other ones. So there's lots of competition in this connected workout equipment device. So maybe they're not, but I truly think they have the best brand. They have a huge loyal fan base. I think they're going to be one of the major players in this market. And I think if you think those two things, there's no doubt they're going to have a huge growth in the commercial sector. And again, the way I look is, yes, you're going to have a lower, they're not as profitable, but they're going to sell en masse. I can see them selling, hey, Hyatt, hey, Hilton, hey, Princess Cruises. Here's a way to sell, here's something to offer your clients. Get a Peloton, and yes, we're going to give you a discount on the price, and even on the subscription. But it's going to be such a big market that's going to be really profitable for Peloton. And actually, if you see here, they even have something called a Peloton Hotel Finder. So, if I'm a huge Peloton fan, which there are, people can say, I only want to look for a hotel that has a Peloton. This is a selling thing for hotels. Now, this so far has not really, when they purchased it, I think, like me, I think a lot of people thought, hey, COVID's winding down, and then people are going to go back to hotels. Unfortunately, it's lasted longer than we thought. And because of that, a lot of hotels and cruise lines have just worried about staying in business. They're not going out and spending hundreds of thousands of dollars on new workout equipment. They're saying we need to cut costs as much as possible just to stay in business because we lost so much money over the last year and a half, 2 years, which is reasonable. But I really do believe that this is going to be a big segment in the future. And again, maybe it takes another year till this really gets going, but I could see them selling it to a ton of fitness centers, a ton of hotels, a ton of cruise lines, residential apartments. I know that I used to live in a condo. I think this is like perfect for a condo. I think people, especially the bougie high-end condos, I think they could buy a bunch of these. So I really think that my two things are, one, the transition from low margin devices to high margin subscription revenue. It's going to take some time, but I think that's a really interesting thing, and they're going to continue to grow their subscriber count. That's, I think, just going to continue to grow. You can see here. And what do they actually say is their 4.4? They are projecting 2.8 million connected fitness subscriptions by the end of the year. So that's, again, is it as strong growth as they've seen? No, but they pulled forward growth. So, and I see a lot of untapped potential on the commercial side. So I'll end with this. Again, what's driven the price has been mood momentum and slowing growth, all that. I think the underlying numbers are still optimistic. And when you actually look at it, this is pre-COVID. In November 29th, 2019, you can't really see it here. I'll scroll up. The stock was $35. And today it's $35. It's barely up. And in September 2019, they had less than, I think I saw in the other one, they had about 500,000, I don't know what numbers these are, but they had, let's just call it 500, it's in thousands, 500,000 connected subscribers, and now they have 2.5 million connected subscribers, so 5 times as many subscribers. So again, the price of the stock is the same as it was here, yet they have 5 times more subscribers, and their overall revenue was 4x, and they're projecting for 4.5x or something like that. I think that makes no sense. Do I think that it got overheated up here? Yes, I really do. Do I think it was worth 170? Probably not. But do I think it's worth more than 35? Yes, I think it's probably worth, my 3-year target's about $70, so double, which is very good. But I really do think this company, again, it could trade sideways for a full year, could even trade down for the next year. But I really do think that eventually you're going to see this transition in their numbers, and people are going to realize, oh shit, it's not about the total revenue, it's about the total gross profit, and we're getting a lot of really valuable subscription revenue. So I really see that being the case. And again, I also see some positives in a backstop. Again, if it keeps sliding, I think that there's a bunch of people that would be happy to acquire it. I could see Apple acquiring it is they want a connected fitness. They want to grow in fitness. I remember reading Tim Cook said in a couple of years, I want people to see Apple as a health company. They got the Apple Watch. I think that this would really be a valuable asset to for Apple to acquire. I've heard Nike. Again, they're also trying to get into fitness. Lululemon acquired a connected fitness company. Nike could easily do this as well, and I think it kind of makes sense with them. How did they go from just selling like something that, again, you sell one off, hey, I sold you some sneakers, to getting a recurring revenue with someone where you're making money from them every month? That's what everyone wants to get towards. I've also heard one that's like Netflix. Netflix, you already pay a subscription month after month. Maybe they go from, again, I believe Peloton's the Netflix of fitness. Maybe Netflix says, hey, we want to get into the subscription game. Here's another way we can get another subscription from you. Yeah, you have entertainment. Now you also have fitness with us. That one I think is a little tougher to see, but I think Nike, um, Lululemon, or Apple all make sense as an acquirer. And I think typically when you acquire, you're buying it at a 40% premium. So, let's say it slips a little bit and then someone pays a premium. I'm a believer, I'm going to hold it. I really think that it couldn't drop too much more because someone will acquire it if it gets too cheap. And I still think that the company has a lot of room to run. Again, if you can't handle volatility in the short term, I wouldn't look into this, but I really do believe in the long term, again, 2 to 5 years, I'm a big believer that this stock could easily double. I'm a big believer. I think they're still early on. They're still mainly bicycles. They had the tread also, which cost a lot of money. They had a recall of the treadmill, but the treadmill market's way bigger than the bicycle market. So they have lots more devices they could do with the treadmill. I could see rowing machines. There's a lot of gym equipment that they could make and grow their total market. So I think, again, they're going to grow their market, which means growing the subscriber count, which means they're going to be, again, 4 times. Again, it's like Netflix. You want to grow that subscriber count, and Peloton has 4 times the price of Netflix. Again, it's $40 a month, so it's like $10 a month for Netflix. So I really see this company as a good deal. And again, it fits my framework of, I think it's undervalued right now, or at least fairly valued at 35. I see huge growth potential here, and I think the product's great and people love it. So those are my thoughts on Peloton. Thanks so much for watching. Let me know in the comment section below. What do you think of Peloton? Are you nervous about the growth rates? Obviously, I am, but what do you think about my thesis around the transition from connected devices to subscription? Thanks so much for watching, and talk to you next time.